So Supermicrocomputer, symbol SMCI on the NASDAQ, is a provider of application-optimized high-performance server and storage solutions. The company develops and builds server and storage solutions at scale with its building block solutions. The company manufactures motherboards, server racks, and enclosures, but the CPU, GPU, storage, memory, amongst other of more the compute components are bought and then integrated into the server they assemble it. The stock has had a turbulent year, to say the least. The stock is trading at $26.77. A share down for about 6% year to date, which doesn't really sound turbulent. At 6%, that could be trading on a day, and that would be turbulent for a day, not a year. However, the stock skyrocketed to over $120. At its peak was actually $1,200. They've done a 10-for-1 consolidation, but $120 adjusting for that. So it is now down 78% from that peak just in March of this year. The market cap is currently at roughly $14 billion. So a quick overview, really a timeline of the negative events on some of the biggest decreases in following various events since March. So April 19th, the stock fell 23% as the company did not provide preliminary results like it had done in the past, which generally just worries the market. When you see a shift from a norm, that really spooks the market whenever you have anything like that. It can be not a big deal once things come, but it can spook, especially when you're looking at these forward-based numbers like SMCI is. Then moving forward to August 7th, the stock fell another 20% after poor preliminary results for its fiscal Q4, notably weak margins, with a gross margin of only 11% compared to prior quarters in the last couple of years being in that 15 to 19% range. So when you are seeing a 4% 4% drop in gross margin sequentially quarter over quarter, that is just a red flag, signs to worry. Then August 28th, Hindenburg Research, a short seller, released a short report on the company, causing the shares to fall 19%, with alleged fraudulent accounting actions being really their primary reason, as well as some various relationship issues between them and related companies, amongst other things, about a 40-page report. But that really can be summed up with alleged fraudulent accounting actions. So moving forward to September 26th, the Wall Street Journal reported that the U.S. Department of Justice was probing SMCI, causing shares to fall another 12%. People really taking that as validity to the Hindenburg report. Then on October 30, brings us to the massive share price collapse of 47% over the past few trading days, as SMC's auditor, Ernst & Young, EY, resigned, which I'll get a bit deeper into that in a minute. So looking at the released unaudited results for Q4 with revenue of $5.3 billion, up 143% year over year. So great growth. That's what people were expecting. That's why the stock was trading at such a higher value earlier in the year. This growth was expected. But now gross margins are significantly lower at 11.3%. The expectation is still for revenue growth, but top line growth doesn't mean much if you can't convert it to profit. That's true for every company, and declining margins really just restrict that possibility. The company does state it expects margin compression only to be in the near term and really to be in that normalized range by the end of fiscal 2025, so halfway through calendar 2025, once its block solutions ship en masse. But now, just coming out today, it is actually being reported initially by DigiTimes that NVIDIA is now rerouting orders that were previously with SMCI to other server providers, which could really throw a wrench in that growth down. So if they can't get that scale, they can't get that margin, they're not getting either that top line revenue as well, if that is true, and that does come and actually materially impact the company. The company earned 55 cents on a diluted per share basis, accounting for that 10-for-1 split. You'll see up there it's $5.51, but it's 55 cents after that split. So one of the core reasons before even any of the fraud allegations or audit resigns, which is something I highlighted earlier in this year when I covered the stock, was just they had an absurdly high valuation for what they do. And it was just extremely, extremely expensive. Just looking at the price to sales, you can see the company shifted from a price to earnings really below 1 prior to the AI boom. You do expect to go upwards. It's a new opportunity for the company. It makes sense for it to go upwards. But it went up to 7 times sales. And now we are back at a 1-time range. In my opinion, the stock was just extremely overvalued in the prior to this last 9 months of dropping, effectively 8 months of dropping. So even when valuing the company using the current stated results, assuming that's all true, the management is good faith. Their sales are correct for the trailing as well as their forward looking at fiscal 2025. It's still trading at a trailing sales of 0.9 times, trailing PE of 13.3, which is more in line with historic results. But if you were expecting a growth, you would expect something a bit higher than that. But it's closer to historic results than the absurd valuations you were seeing only a few months ago. So if you can believe management, which I personally don't believe, and I'll get into the auditor opinion in a second, the stock is now trading at roughly 0.5 fiscal 2025 sales, which is cheap even by historic standards, even before the AI boom. So right now, the bull case is effectively, do you believe management projections? Do you believe their past data? Because if you were to, they are likely trading at a discount if everything could be believed and taken as fact. But the reason why I and many others at this point put doubt on the management is the company has not filed its 10K audited annual report ending June 30th, 2024. The company has since had its auditors, EY, resign after significant concerns over internal control, board independence, and transparency. SMCI quoted EY's resignation letter stating, "We are resigning due to information that has recently come to our attention, which has led us to no longer be able to rely on management's and the audit committee's representations and to be unwilling to be associated with the financial statements prepared by management. And after concluding, we can no longer provide the audit services in accordance with applicable law or professional obligations." Effectively, they are wiping their hands clean of SMCI. They were only contracted for fiscal 2024. Previously, there was a different auditor, so this was their first fiscal year as an auditor. So it's not like they were going back 5 years; they were going back 1 year on their own work. So, and as a part, being listed on the NASDAQ, the company has to file timely, which for SMCI was at the end of September. They got an extension, but if they don't file by November 20th, they can actually be delisted at that point, unless they provide a credible plan to file. If they do provide a plan and it is accepted, it pushes out a delistment date to February 2025, which that is pretty much the hard stop date. They'd get delisted at that point if they're unable to produce earnings. The impact of delisting can directly impact the ability of institutions because they have rules behind their investment policies that they have to own stocks traded on exchanges. As well, it can further breach their debt covenants, which have been pushed out to the end of calendar 2024 at this time. But they would be in breach if they were their debt covenants if they were to wait till February 2025. Management does not expect to need to restate its fiscal 2024 results, but the fact the auditor resigns should not be understated, as it does pose a risk to delisting as well as restatement, which could just further eviscerate the stock price if either or both occur, especially if there is restatements that can just obliterate a stock. It can send it to zero or near bankruptcy very quick, depending on the degree, and you don't really know that until it comes out. So a lot of risk embedded in that. So overall, I just wouldn't touch the stock. Under a long-term fundamental investment philosophy, if you can't rely on the financial statements or the management, which I believe so to be true in this case, it's effectively radioactive. You don't want to get near it. It's just such a high risk, and it's something that you can't really predict because it's behind closed doors, effectively. But even then, the company is now facing increased competition from the likes of Dell, HP, amongst other players. A big reason for their growth really was they moved into AI-focused server solutions quick with their liquid cooling. But now other players are starting to catch up in design. They had that first mover advantage, and then that's now looking to disappear a bit. SMCI was nimble, but the first mover advantage can really only take you so far. So I'm even having a hard time buying into that growth story. Even if the financials are correct, there's still risk. You still could have margin compression because they've always had historically higher gross margins than their competitors. But if they're scaling up, they might have to reduce. They have to sell en masse, lower margins at times. So even then, the valuation is not like it's a extreme discount or anything. There's even risk, even if the financials are completely correct, completely true, and reliable. The risks are just overall too high. But I will mention they are reporting the night of or the morning of after we post this podcast. So we'll see if any material changes happens with that.
Yeah, on top of a valuation risk that certainly was there 2-3 months ago, you have you have this risk of accounting issues, risk of and I'm putting it nicely there. It could be fraud, it could not be at this point, but there has been tremendous growth with the business. What Brett talked about more competition coming in, because it isn't a super high end business. It's easy to protect those margins. So, uh, it was funny when I did do that panel, the analyst was sitting next to me, and the stock was then, this was September 12th. I just looked it up, $44, saying it was super cheap at that time. But like, again, when we look back at it at that price, it was not super cheap based on historical multiples. And Brett talked about that. Any analyst worth their salt would see that they were trading insanely high multiples based on what the business does and historically. So the drop that he saw that made them, in his opinion, super cheap, was from unrealistic levels. It is still needed to drop further and significantly to come more in line with historical multiples. So you've got to be careful who you're taking your advice from. Even if they do look like a pro analyst, make sure that they're doing the right calculations on the business, because again, in our opinion, at that time, that was not a company that looked super cheap historically, because it was trading potentially slightly below the average PE. Well, it had for like 10 years, 20 years, so, and it should trade below because of the type of business that it was operating in.